Today we're going to cover several items. First, what is disability insurance? Secondly, who needs it and why? And thirdly, what are the components of the contract which makes one policy more comprehensive than another? But first, let's talk a little bit about who needs disability insurance and why they need it. Think about your largest asset. Is it your home, your car, a piece of jewelry maybe? Those would all be typical responses to that question. But what most people don't realize is that all of those things are purchased from your income. Your income is typically your largest asset. Think about how much you earn in a year, and think about what that would be over a lifetime. If an individual earns $50,000 per year and he or she is 25 years old, in a 40-year period he or she will earn $2 million. And that's without any sort of inflation. If you factored in modest inflation, that number could easily be twice as high. The point is that if your income is your largest asset, shouldn't it be something that you insure? You buy fire insurance just in case your home burns down, but the value of your home is something less than a lifetime of income. You buy auto insurance just in case you get into a car accident, but the value of your car is worth a mere fraction of a lifetime of income. Essentially, you have insured all the golden eggs in your life. But have you insured the goose? Disability income insurance insures the goose. Ultimately, if your lifestyle would be affected by your income stopping, then it's important to insure it. So we've established who needs disability insurance and why. But now let's talk a little bit about the details of a disability insurance contract. There are a number of features that go into making up a disability policy. First is obviously how much benefit you purchase. That is a percentage of your monthly income. Most insurance companies have a limit on how much insurance they will issue. For incomes less than $100,000, that limit is roughly 60% of your gross salary. If you earned $50,000 per year, you could purchase a policy which would replace $30,000 of income. For incomes over $100,000, the percentage you can insure drops down. The second variable is how quickly does the policy pay? Does it pay after you've been sick or injured for 30 days? Does it pay after you've been sick or injured for 60 or 90 days? That's called the elimination period. That's the amount of time that needs to elapse from the onset of the disability until you get paid. Most people choose a 90-day elimination period because it's less expensive than the shorter waiting periods. Since the policy is insuring against the impact of a long-term disability, most people can find a way to survive financially for the first 90 days. The next variable is the benefit period. This is the maximum duration of payment while you're disabled. Typically the choices are 2 years per disability, 5 years per disability, or even all the way to age 65 if you were disabled that long. So the three primary building blocks of a disability policy are how much, how quickly, and for how long. There are three components which also impact how comprehensive a policy is. First is the definition of disability. Some policies pay if you're unable to do any job. Other policies pay if you can't do the job that you're doing at the time of disability. The next component is whether or not the policy will pay for a partial disability. Many disability policies will pay if you're totally disabled, but the better policies will pay if you're partially disabled. Typically, they will pay in proportion to your lost income. If you're working half-time and earning half of your income, then the policy will pay half of your benefit. This is referred to as a residual, partial, or proportionate benefit for a disability policy. This is a very important feature to have. Often disabilities start out as a partial disability, and in many cases never even become a total disability. The last thing that's important to consider when evaluating disability insurance is whether or not the policy indexes to inflation. Thinking back to that 25-year-old we talked about at the beginning of the segment, if he or she is disabled for his or her entire life, think about what would happen to the buying power of the dollars that he or she was receiving. It's important to have your policy indexed to inflation so that each year the benefit increases with a change in the consumer price index. You will find that the better policies increase each year using compound interest, not simple interest, and you will find that the better policies also do not have a cap on how much that benefit will grow to. So now you know the basics of a disability policy. Let's take a look at how they work. In order to be considered disabled under the policy, you need to be sick or injured, under a physician's care, The illness or injury must be causing at least a 20% loss of time or duties and a 20% loss of income. Now, did you get all that? Let's go over it again. Okay, sick or injured. That makes sense, right? If you're not sick or injured, you're not disabled. Under a physician's care. The insurance company wants proof that there's something wrong with you. The illness or injury must cause a minimum of a 20% loss of time or duties. For example, if you were a surgeon with a broken hand and 25% of your day was doing surgery, then you've lost 25% of the duties, and you would meet the definition. If you were a lawyer and you normally work 8 hours per day, but because of migraine headaches, you can only work 6 hours per day, you have a 25% loss of time, and you meet the definition. And the last piece is a minimum of a 20% loss of income. Sometimes a business owner could work less time or do fewer duties and still have the same income in the short run. And because of this, the policies also require a minimum of a 20% loss of income. So far, we've been talking about disability policies to replace your income, but there are also policies which reimburse a business owner or professional for their overhead expenses if they get sick or injured, and those policies are called disability overhead expense policies. There are also policies you can purchase on a person who is important to the success of your business, say a top salesperson. They are called key person disability policies, and they reimburse for a lost income if a key person gets disabled. There are even policies to ensure that if one of two business partners is disabled, that the healthy partner receives a lump sum of cash to buy out his disabled partner. And you guessed it, that policy is called a disability buyout insurance policy. Now, the majority of people out there who work for bigger companies have some disability insurance provided to them from their company as part of their benefits package. This type of insurance is called group disability insurance, or LTD for long-term disability. That's a great employee benefit to have, but it's often not enough to satisfy a person's full income replacement. So even if you work for an organization that provides disability insurance, you still may need to supplement your group policy with an individually owned policy. If you work for a smaller company or you're self-employed, the situation is more straightforward. You should purchase disability income insurance. Lastly, I'd like to tell you a few things about being disabled that people don't always think about. When you ask most people to envision themselves disabled, they picture themselves feeling perfectly normal, just inconvenienced because of a cast or a wheelchair. This is far from the case. Often people are in pain, and it's very hard to work effectively when you're in pain. Alternatively, disabled people may be taking medication, like painkillers, which render them completely unable to do their jobs. Sometimes a disability could even prevent somebody from sleeping well, so sleep deprivation could hinder your ability to do your job. The bottom line is that even simple disabilities like a broken leg could prevent you from doing your job. Well, that's the basics on disability income insurance. Thank you for your time, and don't forget to insure your biggest asset, your income.